Okay, so lots to track, and it's an interesting session that we are looking ahead to. Jahangir Aziz is now joining us. He's Managing Director, Head of Emerging Markets Economics Research at JP Morgan. Jahangir, great to have you with us here. Thank you very much for your time. Is this finally the pivot party moment, Jahangir? Are we finally there after sort of trying to call it all year through? Are we close to it now as we end this year? What's your sense?
Look, I mean, all that Powell did was to remove the extreme risks that the market had, that he could go far more aggressively than what he had said in November. If you listen to him carefully, he talked about the stepping down, and that was always in the price. But he insisted that this would be, a long haul. So I think that the market is forgetting that the terminal rate is going to be significantly higher than what we had in mind, let's say back in November or beyond that, and that it is going to be there for a very long period of time. I think the risk that they go way too aggressively, I think more or less that has been taken out. But I don't think that there is any pivot as yet. You will get a step down, and then you will continue to see the Fed raising rates till they reach the terminal rate, which is probably at 5 or higher than 5 sometime in the first quarter of 23.
That's fine. But Jahangir, the point is, as you said, if they did not raise any fresh alarm about inflation, right? New alarm. I mean, and that's what the market really is bothered about. Isn't that at the margin good news? And will the market keep responding to this? Yeah, go on.
No, of course it's good news. Look, there is a disinflation process underway. There is a very large disinflation process underway. But that disinflation doesn't take you to the 2.5% comfort zone. That disinflation stalls sometime at around 3.5%, or even before that. And I think that the first part of that disinflation is easy, and that's what is happening right now. So there is no question that a disinflation is taking place. The question is the rate hike sufficient to take that disinflation process beyond the 4-5% to the 2.5%? And that's where the biggest doubts are, because you haven't seen that kind of support coming from the labor market. As you spoke about, at the introduction, today we'll get to see what the labor market is doing. And if you look at what is happening to inflation, goods inflation is coming down, food prices are coming down, energy prices are coming down, but service inflation, that's keeping on rising, and that's where the wage growth pressures are going to be felt.
Jahangir, morning. Rima here. The current consensus is that the terminal rate in the US is going to be around 5%, and we'll hit it sometime in the first half of next year. What is the risk that the terminal rate actually turns out to be a lot higher than what the market is anticipating? Do you think, what according to you is the probability of that? Are we undervaluing the risk right now of this higher for longer?
So we put out a global outlook around Thanksgiving, so about a week, 10 days back, and that was one of the scenarios that we were looking at. We have a probability of about 28%, but it's a scenario where the Fed reaches that 5.25 level by the first quarter of 23, and then goes in for a pause, hoping that the lags of monetary tightening will start, having its effect. And our concern is that maybe inflation is so entrenched and the labor market does not break soon enough, so that that additional disinflation that is required to take it down to comfort levels of 2-3%, that doesn't happen, and the Fed is forced to start rehiking aggressively in the second half of the year. And we have about a 25% odd probability to that scenario. So yeah, I mean, there is a scenario out there where things work out this way, but not that the terminal rate keeps on going. The terminal rate is taken to 5.25. We go for a pause, and then you're forced to rehike.
Hi, Jahangir. Good morning. The last time we chatted, we were wondering whether or not the dollar index has peaked out. It's corrected substantially from around that 115 to sub 105 odd. Now, do you believe that that 115 is a bit of a peak? And more importantly, what does it mean for the Indian rupee? Because that as well had moved to around 83 odd. but that's pulled back a little bit. So trajectory on the currency space?
So again, the rupee is clearly benefiting from the fact that dollar is weakened, and the dollar has weakened over the last 2-3 weeks, largely because of the shift in market sentiment towards how much rate hikes will be there. As I said, we'll have to wait and see where the terminal rate goes and where, what happens to European growth in the fourth quarter and the first quarter. Right now, all the fears that we have about European growth going down and going into a massive recession, the recession fear is still there, but it's much shallower. And I think it is these two things that is weakening the dollar and strengthening the euro at this point in time. In terms of what it does to the rupee, I think it obviously will get some relief because the dollar is weakened, and there's no doubt about that. But rupee's problem has very little to do with the dollar. Rupee's problem has to do with the fact that India is running a very large current account deficit, is running a very large fiscal deficit. It has inflation still around 6-7%, and it is providing almost no compensation for that macro risk. So I know that you keep talking about how the FIs haven't moved in either in the equity or in the bond space, but there's a reason why the FIs haven't moved in. There is a massive macro risk on India, and there is very little compensation either in the high equity valuation or in the high bond valuation or on the high FX valuation.
All right. Jahangir, if you could give us a couple of numbers on inflation, what are you working with for India as well as the current account deficit?
So the current account deficit we're working around is, look, we had only one quarter of this fiscal year, which was around 2.8%. We think that the current run rate is about 4 to 4.5%. We think for the year as a whole, we'll end up around 3.5%. That sort of is the current account. I think, inflation will probably get into the 6 handle and probably into the upper 5 handle in next year. But, the disinflation process in India is going to be very different from the disinflation process elsewhere in emerging markets and globally, because the inflation over there was much stronger. And so while in the first quarter of 23, we expect emerging markets in general to see almost a 200 to 250 basis points drop in inflation, I think that is unlikely to be the case in India. India is going to be much slower disinflation taking place. So those are the numbers that we are working with. But really, the key number that we are working with is the amount of current account deficit.
And that's the risk that you're highlighting, right?
That's the risk that we're highlighting, that we are not. India isn't compensating for that macro risk, right? If you look at other countries with those kinds of fiscal deficit numbers, current account deficit numbers, their interest rates are much higher. Their equity valuation is much lower. Their FX is much lower.
Right. No, I get that. Jahangir, just a quick point on the U.S. slowdown itself, right? Because that's a big one. Because exports out of India, a big one, right? Both services but services more than goods. So all of that depends on what happens in the U.S. Is it going to be a sharp, swift one, as compared to a kind of a not so sharp but a prolonged kind of phase of recession in the U.S.? And is it important that it is one or the other for the outside world? Your sense?
No, I mean, clearly it matters whether or not U.S. goes into a deep recession and when it happens. Look, we have a baseline in which the U.S. economy slows. It's going to run around 1.5% in fourth quarter, and then it slows down as the impact of the monetary tightening starts biting. We've already seen the impact of the monetary tightening in the housing market. We haven't seen that in the labor market. And when we are expecting that to play out in 2023, we only have a call for a recession only in the fourth quarter of 23, and that too a very mild one that gets extended into the first quarter of 24. So we are of the camp that the amount of monetary tightening that has been done is unlikely to get you to unemployment rates or to the kind of destruction in demand where you will see disinflation fall like a stone, and therefore the Fed will be forced to cut much earlier, or at least where the market has. Market is expecting the Fed to start cutting in the second half of the year. We don't think there is any rate cut taking place until you get into 2024. So that's our baseline.
All right, Jahangir, we'll leave it there. Thank you very much. Great speaking with you as always. Great insights. Thanks very much. So that's a solid perspective right on the top of the program from Jahangir Aziz.